It's February of 2007, and the Fed has just completed the most aggressive cycle of rate hikes since the 1970s, something that has preceded every single recession in modern financial history. The yield curve is inverted, also signaling a recession, and businesses are reporting that it's becoming tougher and tougher to borrow money. The conditions that are needed for a recession to occur are all in place, and it does occur. In December of 2007, the stock market peaked and began a vicious bear market. Unemployment during that period rose to the highest level since the Great Depression. Today, the Fed has just completed the most aggressive cycle of rate hikes since the 1970s. The yield curve is inverted, signaling a recession. Businesses are reporting that it's becoming tougher and tougher to borrow money, so the conditions are in place for a recession to occur. So where is it? Real GDP is growing at a healthy 2.5%, which means that even when we adjust for inflation, the economy is actually growing at a healthy pace relative to anything we've seen over the last 40 years. The unemployment rate is still very low, hovering at the lowest levels we've seen over the last 50 years, and the stock market, for the most part, has been quite strong. So our theory today is the following. Yes, we are in a period of economic expansion. We're seeing true market strength. GDP is strong. Unemployment is low. This is not a fake economic boom, but it's also true that we're coming closer and closer to the end of this economic expansion. And when the economy is no longer expanding, it's contracting. But in order for the economy to flip into this next phase of the economic cycle, we need to see some sort of catalyst. Without it, economic strength could continue despite these warning signals that we're seeing. This is exactly what we've seen again and again throughout history, with no exception. If we look at the 1990 recession, for example, leading up to it, it was also more and more difficult for businesses to borrow money, and the yield curve was also inverted. These conditions were signaling that we were towards the end of the business cycle, and that period lasted for almost 2 full years. What actually triggered the recession in 1990 was an oil shock. Oil prices in 1990 rose by 40% very rapidly as a result of the invasion of Kuwait. This is also what triggered the recessions in the 1970s, oil prices rising by 40% very rapidly, quickly triggering an economic downturn. But not many people know that's also what happened in 2007, where oil surged by 40% and precipitated the recession that was building. Indeed, leading up to that oil shock, businesses were having a more difficult time borrowing money, and the yield curve was inverted. So again, the conditions were in place for a recession to occur, but it wasn't until we had an oil shock that the recession actually materialized. So the 1970s, 1990, 2008 recessions all saw an oil shock as their initial catalysts. 2020, of course, we know the pandemic was the main shock. In 2000, we have the same story. The Fed had been raising interest rates, businesses were having a difficult time borrowing money, and the yield curve was inverted. But the catalyst of the recession was actually the stock market crash of technology stocks that occurred in 2000 that followed the speculative bubble that developed in the 1990s. That's why the 2001 recession is known as the dot-com recession, associated with the popping of the dot-com bubble. And so that brings us to the third type of shock that can trigger a recession. We've seen pandemics, we've seen oil shocks, and now market crashes that can trigger recessions. In 1929, Black Tuesday is often believed to be what initially triggered the Great Depression, explaining the complete 180-degree turn that the economy made between the 1920s and the 1930s, from extreme optimism to extreme pessimism, all with one crash. And by the way, when that crash occurred, the conditions for a downturn were also in place. The Fed had been raising interest rates for a while leading up to 1929, and the yield curve had been inverted for almost 2 years. The conditions were in place, but Black Tuesday is the catalyst that triggered the run on the banks and the depression that followed. So what is it going to be this time around? Is it going to be an oil shock, crash, or a pandemic? Let's hope it's not a pandemic. And statistically speaking, most of the recessions that we've seen over the last 50 years have been triggered by oil shocks. So is that going to be the trigger of the recession this time around? Oil is indeed up quite significantly recently. We also have clear evidence of rising geopolitical tensions in the Middle East. So it could be that the big catalyst comes from a type of big oil shock like we saw in the 1970s. For an oil shock to occur and trigger a recession, we need to see prices go up by 40% rapidly. Oil would need to rally from current levels to $111. If that happens, it would guarantee a recession materializes just like it did in the 1970s, 1980s, and 2007. But 2024 is not exactly like the 1970s or 1990s for that matter. The United States has significantly ramped up its oil production since the 1970s. In fact, compared to every single oil-producing state, United States is the world's largest oil producer. So in order to see a large oil shock, we would need to see an outright war breakout. And when we look at the technicals on oil, they're not yet telling us that oil has broken out. Yes, oil has moved up, but it's still testing resistance, and it hasn't been rising over the past week despite a lot of news coverage. So this is the big level to watch. If oil breaks out with rising tensions in the Middle East, we could see that type of big oil shock. This is something we're watching very closely on Game of Trades because rising oil prices would significantly increase the probability that we see a larger pullback on the stock market and possibly even a recession that would be associated with a much larger pullback in the market. But for now, that's not the case. The price structure on oil is bearish. And if geopolitical tensions calm down, we'll see oil prices go lower and possibly much lower, which could be a great thing for the stock market. So in that event, the only possible catalyst left would be some type of a market crash. And stock market valuations today happen to be at similar levels to what we saw in 2000 and 1929. So the potential for a much larger market correction like we saw in 2000 and 1929 is definitely there because of how expensive the market is. But there is one component missing. We haven't seen the same extreme returns that we saw leading up to these market peaks. In both 1929 and 1999, the 5-year return of the stock market was above 150%. Today, it's at 72%. So for now, we're not seeing the same type of euphoria that we saw during those periods. Of course, that could always change very quickly. So although the conditions for a recession are in place today, we don't clearly see what the catalyst for that recession is going to be. As long as there is no shock to the economy, we think this dip that we're seeing on stocks is an opportunity to buy. The stock market broke out of an important price channel back in January of this year, which is a very important technical development. Now, we were expecting a pullback to occur in the near term. We thought the market was overextended and vulnerable to a pullback, but the overall technical structure on the market today is that it suggests that we should be preparing for a big bounce on stocks and that the market strength could still have some room to run. This is how we follow the key levels on the S&P 500. It's not rocket science. We keep it simple and we try to keep it objective. While we are seeing a pullback, the overall structure of the market doesn't suggest that we're going into an imminent downturn. Throughout February and March, we've been patiently waiting with our members for this type of opportunity to buy stocks at a discount. We had very limited exposure to the stock market heading into this correction. Now we're going shopping and we'll be adding quite a few trades to our list of active trades on gameoftrades.net.